Well, I hope wherever you're logging in from, you have a beautiful day like we have in Maryland today. We've had some stunning fall weather. The leaves are probably at their peak, and it just makes me happy for the change of seasons.
And the perfect backdrop for Halloween.
Yes, happy Halloween to everybody. Okay, well, let's go ahead and get started. We want to be respectful of your time. And if you're looking for long-term care insurance information, you come to the right place. We want to thank our host, Northrop Grumman Federal Credit Union. And you will see this is Sarah and me presenting today from Blue Heron Financial Group. So we're going to get started, and we'll probably take about a half an hour. If there are any questions after today's presentation, we'll leave the closing slide up. You can all feel free to reach out to Debbie Schilling at lpl.com. But again, we'll leave that slide up at the end. So let's go ahead and get started, Sarah.
Very good. So jumping in, let's make sure this goes forward. So we will be talking about the one choice that can impact generations, which is long-term care. So what is long-term care? Long-term care is often referred to as custodial care, long-term care, extended health care, and it is care for those that are unable to perform basic self-care tasks. So this can be due to an injury, trauma, illness, or factors associated with aging. Oftentimes, the image that we conjure up, or I conjure up at least when thinking about long-term care, can be nursing home care. But in many cases, people really prefer to age in place. They prefer to age and receive care in a familiar place, such as their home. And oftentimes we see that care really is a progression. In the beginning, it can oftentimes be a caregiver coming in a couple of times a week, then maybe even more than that, and eventually needing to go to a nursing home to receive care. So it can be a lot of different things, and it's not just a one-size-fits-all nursing home. Lastly, we have requiring assistance with activities of daily living, kind of what was touched on earlier. We hear a lot when talking about long-term care, ADLs, and that stands for activities of daily living. Here are the 6 up here, and it can also, long-term care can be required if there's severe cognitive impairment with a disease such as Alzheimer's or dementia. And we, again, think a lot about the physical sense of caregiving, but caregiving can also be the emotional side, companionship, and just having someone there as well. I will go ahead and put up all these facts and figures here. Okay, we'll go back here. So just taking a moment to look at these figures. These are from 2020 for some of you on the call that maybe have personal experience with a parent or a grandparent or another loved one. You can look at these prices and maybe these seem low, maybe they seem high. These are just the averages, so the middle of the road expenses. We can send it as a follow-up, but certainly we would encourage you, if you have never looked into the price of care in the area where you live, we would highly encourage that. And even for those of you that are looking to retire somewhere else, to be thinking about what the cost of care will be in the place that you want to live. So we have the average length of time for men needing care is 2.2 years. Again, thinking back to what those annual amounts were at the different levels of care, and we can see how this can start to add up. For a woman, it is 3.7 years. And for someone that has a cognitive disease such as Alzheimer's, an average of 8 years. So really important as we start to put the facts and figures together with the time you may require care. It just shows what an important conversation this is. Here is more of the extreme side, but these are 7 different insuring carriers, and these are their largest claims. So just taking a moment to look here, we see that male and female, both claims are running neck and neck, both in time and cost. All of these claims are over $1 million, and it's hard not to think about your own financial plan and, God forbid, if you needed to somehow cover the cost of these care, it can certainly be detrimental. And going back to the title of this presentation, how one choice can affect generations, we can see how this can affect spouses, children, and so on, which Margie will touch on later. We think about why is care so expensive, and we have an aging population, and the need for caregivers and care is so high. And certainly we think of those people that they're calling is caregiving, because it is such a special job and it's very important. We were just talking about it in the office the other day. It feels like every time we're driving, it seems a new senior living center is being built. So yes, we can see that there is demand. Longer life expectancies, modern medicine. Sure, certainly it's wonderful if we can be doing the things we want to do, like travel and spending time with grandkids and family members, but longevity certainly has a risk. And we can think, when we run through retirement planning and financial planning, sometimes a client will say, well, I'm only going to live until 85 because that's when my parents passed away. And the truth of the matter is we don't know. We don't know when our day is going to come. So if we only plan until 85 and we're living until 90 and 100 without even thinking about a long-term care need, we can see how running out of money or drawing down on those assets becomes a reality. And then to throw on top of that a long-term care need. Family dynamics. Again, Margie will dive a bit into this, but it's important to be thinking about, especially those of you on the call that may be thinking, well, my plan for long-term care is that my kids are going to take care of me, or my grandchildren are going to take care of me. Thinking about that now and including those people in the conversation as well, rather than just assuming that's who will be providing the care. Government, what programs will be available, who will qualify. I think oftentimes it can be a misconception about Medicare. Some people think that Medicare will cover long-term care costs, and that's just simply not true. Another one we hear a lot is Medicaid. Well, I'll just go on Medicaid. And if you have assets, it's not as easy as just going on Medicaid. You'll have to qualify. Again, we've heard, well, I'll just give away my assets, I'll hide my assets, but remembering Medicaid also has a 5-year look back period. So that might not be an option. Here we have the breakdown of those with Alzheimer's disease and seeing the different age groups and the percentages that are affected by it. And I was personally surprised to see that the 65 to 74 crowd, that number was so high there. In 2021, the 6.2 million Americans had Alzheimer's disease. We were talking about this a bit earlier. November's Alzheimer's Awareness Month. And yes, a lot of research and fundraising is going into the horrific disease of Alzheimer's, but at this point, there is not a cure. And it's projected that by 2050, 12.7 million Americans will be living with Alzheimer's. So as we think about caregivers and the need and the demand, it poses a quandary and how we're going to care for all of these people and how we're going to be paying for it. Another common, I guess, thing that we hear in our office is, well, I won't need long-term care. And unfortunately, the odds just are not in our favor. 70% of Americans turning 65 today will require some type of long-term care service. So if we think about it on a personal note, putting 10 family and friends in a room, 7 of those people needing care. Of that 70%, 20% will need care longer for 5 years. So again, as we think about the cost associated with that, it adds up. I'll hand it over to you, Margie.
All right, thanks, Sarah. Thanks for all the stats. And we put those up there because, again, that last slide that Sarah showed us, 70% of those hitting 65, the odds are definitely not in our favor. So now we're going to talk about just the dynamics behind care. And we've heard from you all so many different responses to well, if I need care, I will do this, or my family will do that. So it's very sobering. You will see behind me my purple flowers from a couple Alzheimer's walk. I just did another one last week. in memory of my mom, but also thinking of, clients who have passed and friends who are now suffering from the illness. So we've got to be realistic about the needs that are out there as a society and within our own families and with our loved ones. So maybe you are going to be one of those lucky ones who do not need care, but let's look at this from the perspective that if you do. And the family dynamics we're going to start with is that partner or that spouse. And I've seen it firsthand, so I will share with you. Again, my mom had Alzheimer's. My dad was her primary caregiver. There's 5 kids in our family, all with families of our own and jobs. We would pitch in where we could, but we saw the progression with my mom and how it was weighing on my dad's health. So we had to have a couple, I will call them interventions with my dad to say, we've got to get mom more help. Whether it was depression or not, it's difficult. And my parents were very, very active socially, traveling, and that was tough. I would always hear my dad say, well, you remember when we did this? Well, clearly my mom wasn't. So that's a tough one. Pulling out the photo albums maybe would conjure up some of those memories from days gone by, but there is that mourning of that previous life. And then the physical challenges, the stress can take a toll in a variety of ways, those that are listed there: poor sleep, blood pressure, weight gain or loss, headaches, and the list goes on. And then if there's a difference in size, as there usually is, one is going to be bigger, one is going to be smaller, and there becomes that dependence on whether support just to move from room to room, but falls come into play. And if you've got that bigger person potentially pulling down a smaller person, but doesn't even have to be that much of a difference. I remember my mom falling. Luckily, my brother and I were both side by side, but she just became this incredible, she wasn't even that heavy, but just the sheer drop of her weight onto us. Thankfully, we prevented her from falling too much. But these are all considerations, and the financial impacts. And this is where we as financial planners have some answers to offset this. Otherwise, you're looking at this retirement plan. You've worked long and hard to amass, to go into retirement. For many on the call, we've gone through the plan and continue to go through the plan as life changes. But if we have to then incorporate the need for care and that cost, you can just imagine how that takes a totally different twist. And it's really about the cash flow, and we'll get more into that in just a minute. So that was the impact on the spouse or the partner. But let's talk about the adult children. So whether it's us thinking about it and our children, or your parents who are maybe aging, and you are living this with your brothers, your sisters, on who's providing the care. So that maybe there is an adult child who's providing more of the day-to-day care, and that comes with that toll to whether it's their own mental health state from a depression standpoint, and substance abuse and dependence on drug or alcohol, and then all these other frustrations that just come to the surface sometimes. Anger, why is this happening to my spouse, my parent? And maybe some are living out of state, back to the adult kids, and the guilt factors, and all of this just becomes very intertwined. The physical challenges we talked about, and then the impact on adult children and their marriages. If one is called away, for weekends, maybe at a time to go take care of a parent, to give the spouse some respite time, then there's that pulling away from the marriage and maybe from their own children who may still be at home, not to mention if someone has to step out of the work world, then the loss to their own finances. So we realize these are those tough things that we don't want to be thinking about too much. Sarah, you can go to the next one, please. But it's important that we have the conversation. Oh, right there, the impact on friends. Again, I'll just share with you firsthand. I've had a couple friends whose spouses have suffered from, whether it's Lou Gehrig's disease, whether it's Parkinson's, and it's difficult to watch this take place when they are the primary caregiver, and their time outside of caregiving becomes more and more and more limited. And so what's there to counter that? Well, that would be to potentially bring somebody in to help. But there's this side of, I can handle it, I don't want to burden. And that's where we believe that the long-term care insurance, it's a totally separate, you're not relying on people within the family or friends necessarily. So it becomes maybe more helpful to know that that's there, that you can rely on it. And then this last bullet here, who will look out for you financially? So if you are single and don't have family close by, I would say it's even that much more critical to be thinking about. We have had a couple clients who have not had that close family. I'm thinking of one in Florida who unfortunately, her brother died. Her husband had predeceased her by many years. So there was not that point person. Luckily, there were a couple friends in Florida who stepped up. She's no longer in a position where she can take care of her own bills and finances. So this is that point of you've got to make sure you've got a trustworthy power of attorney in place. And if you're working with us here at Blue Heron, it's something that we're going to hammer on, because it can be a real quandary if there is not that person in a legal document named. Okay, so we're going to talk about, if you do need care, how are you going to pay for it? We're going to look at the options that are out there. So Sarah touched on this before, but it bears reiterating. It's unlikely that either Medicare or Medicaid are going to take care of the day-to-day needs of someone in progressing, declining health. Medicare is there. Yes, you go into the hospital. The outlook is that you're going to recover from, maybe it's a knee replacement or a hip replacement or whatever that case may be. Medicare is there to take you through that physical therapy and get you on the road to recovery. What we're talking about today is declining health over a period of time and the financial drain that can come from that. Medicaid is going to be available only if there's little to no assets left. So for so many of you who we've been working with, whether short time, long time, the assets that you've amassed, imagine they would have to be spent down. Yes, gifting is a thing, but there's limitations to that gifting, and there is that 5-year look back period. Now, there's also Medicaid trust and things that could possibly be structured. We won't go down that rabbit hole right now, but you're bringing in an attorney and working closely to make sure that you're doing it within the law. So number 2, long-term care insurance. And that's what we're here to talk to you about today, because this is where you're looking at your assets and transferring the risk as opposed to taking it on yourself to said insurance company. We're going to go deeper on this in just a minute. Many have not purchased this for many reasons, and we've heard a lot of different reasons. You know, some have it in their mind they're only going to make it to such and such an age based on maybe their own health, maybe on longevity in the family. I mean, we've heard everything, but at the end of the day, none of us do know. And if the decision is to pay out of pocket, then you are in essence self-funding that financial care, or the care from your own finances and the drawdown thereof. So when we think about our assets and we think about our day-to-day, month-to-month, year-to-year expenses prior to and after retirement, and we've assumed that we have enough assets, we have plenty of assets to live out our days. But on the long-term care side of things, it's not like you can say, okay, well, the long-term care situation has come up, so I need a distribution of, and I'll just pick a number, $30,000. That's just not how it plays out. It is, as stated here with this next bullet, it's an ongoing bill. And I don't know what the stat is clients through this process. It's typically, or personal experience, having somebody to come into the home and help out, maybe a couple days a week, maybe a few hours each of those days. And as time moves on and the need rises for more and more assistance, then that monthly bill is increasing over time. So how would we feed that need when we've looked at this big picture and we've looked at all the sources of income that are coming down the pipe? How are we going to fill this additional possible need? So if the decision is to self-fund, when you think about those assets that you have, and there's a plan in place, and maybe we here at Blue Heron have worked with you to create that income stream, but if that need comes up, then we've got to start sending out more funds from that, and I'll just use the term we like to use here, is the nest egg. And we're determining where we're pulling those funds from, whether it's IRA or Roth or triggering income from an annuity. But now we've got to just increase that to whatever is deemed necessary to take care of that financial bill for long-term care. So that can have that effect throughout the whole plan, and then specifically to the partner or the spouse. You know, we go into the plan assuming longevity, and if one requires all this care over here to what could easily be thousands per month, then what does the non-ill spouse have left for retirement and for that lifestyle? So these are all important considerations here. Leaving children with little to no inheritance, and we hear this, we hear it all the time. I raised them, they're fine, we don't need to leave them anything. And okay, that's very personal decision. In many cases, there is I would like to leave whatever that is to the kids or to grandkids. And then the non-efficient use of tax incentives to leverage own assets. We're going to talk more about this in the coming slides. Okay, so when we saw this demographic, not me, but just as a society and the government, saw this aging baby boomer and how many are hitting 65 every day, and then those that need care. So the government came up with some incentive back in 1996 was the first, where they gave this tax-free use of life insurance to be used while qualifying for long-term care expenses. So I think we can all agree, if we can get tax-free use of money, all the better. And then it was improved upon with the Pension Protection Act of 2006. HIPAA law extended it into the annuity world to be used for long-term care expenses. Again, tax-free. So I'm going to just pause here for a minute and then we'll go on, Sarah. But when we are looking at the nest egg, actually, let's go ahead and go to the next slide, please. Okay, so when we're looking at the nest egg, we have different types of investments. We have our more conservative assets in place. In today's world, we're getting actually paid on some of those conservative assets finally. You know, the good and the bad of the Fed raising rates more aggressively than they have in decades and decades, and getting some yield on those conservative assets. And then we have, I prefer to use the term growth as opposed to aggressive, but we're going with the slide presentation here. Those assets that are more long-term over time, more invested in stock for that long-term growth potential. And then those moderate assets that are somewhere in between. We accept some downside risk and we're still looking for growth. So we're looking at this nest egg. We have different types of investments in here. If we're simply drawing down on the assets in order to pay for care, there's going to be some tax liability, depending if it's coming from retirement assets that were in pre-tax world, then you've got taxation just like ordinary income taxes on any of those drawdowns. If it's coming from your stock, mutual fund accounts, then you may be triggering capital gain taxation, dividend taxation, in order to, again, come up with the finances in order to pay for the care. And again, the same holds true on the aggressive side. So there's tax impacts, bottom line, on any of these. So you saw before that in 1996, the HIPAA law allowed for this combination, this hybrid, we kind of refer to them as hybrid policies now, that have a life insurance component to them, but then they leverage up this bucket of assets that is there available for long-term care insurance. Now, if the need comes up, and again, that's why the asset has been created, it's moved over on the balance sheet. It's still there though as an asset. And the first assets that would be used to be drawn down would be on the life insurance side. If the person died only after using the assets for a short period of time, then there's still a life insurance component to it. So one way or the other, assets are returned either to the estate or through the use of long-term care insurance for the needs. And then we saw in 2006 that annuities could be included in such a way that assets are combining an annuity aspect to it. So, you know, we think of so many different types of annuities, and we could spend a long time talking about all those different types. But there's annuities out there that are not necessarily used for long-term care insurance. They're not necessarily used for the income. We're able to transfer those in as some seed money, I'll call it, in order to create that long-term care insurance bucket for future needs. And then just really within the last year or so, again, part of it tying in with these rising interest rates. The environment changes always, but there are a different type of annuities out there on the income side that are putting in a long-term care additional benefit. So on income annuities, in some cases, there can be an increase of that guaranteed income up to 200%, or coverage for a spouse up to 150%. And on any of these topics, for more information, we go deeper on it, is the best way I can say it. So here's where we are. Sarah and I have presented to you just this overall quandary of, if the need comes up, how are we going to take care of it? If the answer is it's going to be family, it's going to be adult kids, then there really has to be that table fireside chat, whatever we want to call it, about how that could really truly be orchestrated. I have friends who have been in that caretaker role. I have family who have been in that caretaker role. God bless those who have that calling. And if that is the solution, then at least that conversation and that solution is in place. If the answer is yes, I would like to further explore how assets that we own can be leveraged up if that need occurs. I don't need to, beat the table on stats not being in our favor, but really it's about, okay, well, what are those options? And it really isn't just okay, well, I've decided I want to do this, so here's my X amount of dollars. We have to look at health. We start with that. And not to say if, you're taking cholesterol medicine or blood pressure medicine, or, some of these things just kind of come with age. If there's a cortisone injection that just happened, a lot of these things feed into, and here's the insurance word, underwriting. And we have to go to the drawing board and determine, based on what health factors there may be, that this provider could work versus this provider. Again, I don't want to belabor this point, but back to, you have a decision to make on this. The decision to self-fund is indeed a decision. The decision to have family members step up as caretakers if the need occurs, that is a decision. If the decision is to provide this separate bucket of resources so that my family member can tap those if the need comes up, then that is a decision. And we're here to help. We feel strongly about it from just so many different directions, starting with, if that caretaker is you, we know that the toll that it can take. We know that you will try to do everything that you can in your power to take care of that loved one, but there's sometimes the need for your own health to call in some additional resources. So what that can look like from the financial side, again, we're happy to explore it with you. And all the disclosures here, yes, we have to go through those. We're happy to send a follow-up after today's presentation. And we thank you for your attendance today on Halloween. Should I, Sarah? I think I'll have to. I have to. Okay. All right. So on that note, yes, I did have to do some comic relief after such a sobering conversation. So thank you for your attendance today. It is Alzheimer's Awareness Month, and it is also long-term care Insurance Month. So thank you for attending in November. Let us know how we can help. We'll leave Debbie's email on there, phone number. Feel free to contact us and we'll be happy to take a look at this for you.
Thank you very much.